Hi, my name is Lincoln Hill, and I'm going to discuss the accounting changes currently in the works, so to speak, that involve the treatment of content costs relative to the particular industry of online entertainment networks and how the recognition of revenue is affected. The continuously emerging industry has had a difficulty in determining how to deal with externally provided content as well as originally produced content in comparison with cable television network providers and how they account for certain content costs. To begin, let's focus on the effort aimed to improve the accuracy and reduce the limitations of these particular costs associated within the industry. This effort, led by the Financial Accounting Standards Board, focuses on making amendments to subtopics 926-20 and 920-350. FASB considered the Emerging Issues Task Force, the EITF, their Consensus Exposure Draft, issue number 18-B, Improvements to Accounting for Episodic Television Series for ratification at a meeting on January 30th, 2019. From this consensus, they aim to align the accounting for production costs of episodic TV series content with the accounting for production costs of films by removing the content distinction that is limiting. They also decided to allow an entity to assess a film group for impairment and to amend the presentation and disclosure requirements for films and episodic content, as well as agreeing to make some amendments to subtopic 920-350 Entertainment, Broadcasters, Intangibles, Goodwill, and Other, to align its impairment and presentation and disclosure guidance with the task force's decisions. As of February 1st, 2019, FASB posted an update to the issue and where it currently stands on their website. From this update, we can see that the objective of this update to the standard is that there's no question that the entertainment industry has been experiencing substantial changes in production as well as distribution models over the past few years. As an example, the newly introduced distribution channels that offer streaming capabilities in which some companies account for with subscription-based revenue models. Investors are questioning whether the constraint and the capitalization guidance for this sort of content is still relevant or adequate enough. This project is aimed to determine whether existing capitalization models still provide relevant financial reporting in the current business environment. Per subtopic 926-20, Entertainment, Films, Other Assets, Film Costs, provides two capitalization models pertaining to content production within the entertainment industry, also providing a distinction based on the type of content produced. In regards to films, all production costs are capitalized, while episodic content production costs are capitalized subject to a constraint based on contracted revenues in the initial and secondary markets. Following the board's decisions reached at the last meeting on January 30th, 2019, the EITF meeting consisted of a consensus reached by the task force that involved aligning the accounting for production costs of episodic television series with the accounting for production costs by removing the content distinction from subtopic 926-20, Entertainment, Films, Other Assets, and Film Costs. Also, they are now requiring that an entity reassess estimates of the use of film and account for any changes prospectively. In regards to the transitions and effective date of this update, the task force consensus will require an entity to apply the amendments in the update resulting from this issue on a prospective basis and disclose the nature of and reasons for the change in accounting principle, transition method, and a qualitative description of the financial statement line items affected due to the change. For public business entities, the amendments in the update will be effective for annual periods, including interim periods within those annual periods beginning after December 15th, 2019. In regards to all other entities, the amendments are effective for annual periods, including interim periods within those annual periods beginning after December 15th, 2020. All board meeting minutes, handouts, and videos are provided on the FASB website under the Board Meeting Materials and Information section, where respective links are provided for each meeting. Listed here are the meetings and process of the board's deliberations, in which, like I said, all of these can be found. Links also to each of them can be found on the FASB's website. So what's next following the board's meeting? The next step is to issue the accounting standards update. Although keep in mind that the conclusions reported so far are tentative and can be changed at future board meetings. Only decisions are final following a formal written ballot to issue a final standard. Official positions of the FASB are only determined after the extensive due process and deliberations. As an example of a company that uses a subscription-based revenue model is Netflix, for members pay a rate per month that is subject to change, but also Netflix utilizes a free cash flow model as well that is not in accordance with GAAP. Cash payments for content can be found within the company's cash flow statement by adding additions to streaming content assets and change in streaming content liabilities. Netflix uses ASC 920 for guidance on the accounting for licensees of films and TV shows applicable to their business. Netflix records a content liability, current for the portion due within 1 year and non-current for the portion due beyond 1 year, and a content library asset amortized for portion within 1 year and non-current for the portion beyond 1 year on the balance sheet. In summation, the accounting standards update should provide a more favorable revenue-producing environment for streaming providers within the entertainment industry by allowing them to reduce contractual costs from external content as well as original content production costs. If the update is issued, then entities within this industry will be able to capitalize more costs associated with their operations, increasing the amount of earnings retained.